The Fed will have two 25 basis point cuts over the next meetings.
The first time in some 3 months. So what does all that mean for the Fed's November meeting? Now just 2 weeks away. Joining me now to discuss is Richard Clarity. He's the former Federal Reserve Vice Chairman, PIMCO's Global Economic Advisor. Welcome back. It's nice to see you.
Likewise.
Are you surprised by how much rates have backed up since the jumbo cut?
The jumbo cut.
Well, I'm not surprised in the direction. You know, it's been our call for some time that the curve would steepen, and so we've seen a steepening. You know, it's mostly driven on the real side of the curve. It's not really so much about people worried about inflation. And obviously, we've had some pretty good growth numbers, too, both the employment data and then the revision to the GDP data. Now, you know, getting it down to the basis point is tricky, but the direction of travel, I think, makes sense.
Do you think it's going to continue?
Oh, well, I mean, you know, I think it will be data dependent to some extent. And obviously we'll hear from the Fed in a couple of weeks. And obviously people are positioning for various election outcomes. So I'll reserve judgment on that till we have a little bit more information.
All right. Well, what about judgment on how many cuts we're going to get for the remainder of this year?
Our baseline is still that we get another 50 basis points, 25 at each of the next two meetings. You know, coming out of that September Fed meeting, markets were getting ahead of the story a bit and pricing in more than that. I think the recent data and Fed speak has brought market pricing pretty much into alignment with what I think they will do. They're going to take it meeting by meeting. But Scott, I don't think they would have moved 50 in September if they thought that's all they needed to do. So I think a couple more cuts this year would still be the baseline.
Well, let me ask you this. Why should they cut twice? Especially if they're coming to the realization, which I think is true, that the neutral rate is higher than they once thought it was, and that they're not as restrictive as they thought they were either. We cite Atlanta Fed GDP at 3.4.
Yeah.
I don't know whether that pans out to that number or not, but it doesn't matter. The point is that the economy's stronger than they probably thought it would be. The neutral...
Hold your horses for just a moment. Hold your horses for just a moment. What did we just go over here? Starbucks business model is a complete disaster. Their North American business looks bad, right? Enphase business is in a horrible place right now, right? So, I mean, you look at just two data points we got right there, it doesn't look good. It doesn't look good. You know, usually, Starbucks usually has good numbers, right? Enphase many times has good numbers, but they have not had very good numbers recently. So if you look at those two data points, you say the economy is actually not very good.
Rate is undoubtedly higher than they thought it would be. Why should they cut twice?
Scott, I think they've made they have the judgment. I think the minutes confirmed this. And indeed, the chair referred to the initial 50 basis points as a recalibration. I think you are correct. There's a range of views on the committee about neutral. And neutral could be higher than most people on the Fed think. But I think they all agree that wherever it is, it's below the current setting of the funds rate. So I think there will be agreement for a pretty broad range of data for another two cuts. But I do think as we go into next year, I do think they'll be generally data dependent. And whether or not we get the cuts that the dots indicated will really depend upon what happens in 2025.
Well, what's your own view, though, on this neutral question and what it means for policy? Because it's potentially significant, right? They may feel like they have the luxury of not cutting twice, and they would explain it by, look, the economy is strong enough that we don't need to. Obviously, we don't want to reaccelerate inflation in a way that would be punitive to the economy.
Sure. So my own view on neutral is, that the front end of the curve, which is what the Fed sets, the funds rate, I'm more or less in alignment that ultimately once inflation gets to 2, that a neutral rate of around 3% makes sense. Where I do think the world will be different than it was before the pandemic is I think we'll have a steeper yield curve. So I think part of the way that the bond market clears is not so much with a higher front-end neutral rate, but potentially a steeper yield curve on top of that.
Yeah, there's a few dangerous things here. You can't just look at like Meta and Nvidia earnings and say, oh, everything's great as far as the economy goes because Meta's and Nvidia earnings are going to be great. No, those are very special companies. Those are like the 1% of the 1% top companies, right? You're going to start to look beneath that and you're going to find just a lot of weakness from a lot of really top tier companies, even the top 1% type companies. A lot of weakness from those companies, right? And remember, the Fed's trying to, they should be, in theory, skating to where the puck is going, right? That's what they should be doing. And so you got to understand, like, if they cut rates here, it's not going to really be seen in terms of helping for quite a while. You're looking at potentially up to 2 to 3 years before it really starts to matter in any significant way. There's a lag there, right? So that's something that, I think should be front of mind there. The bottom line is, do you feel like things are getting maybe weaker or stronger? I think the moral of the story was in 2024, I think it would be overall, if you had to say a feeling, it probably felt weaker, right? Just looking at a lot of company earnings. And you see it from company after company after company, right? Could they reverse a little bit in 2025? Yeah, it's potential. And I think that will be kind of like, well, inflation not biting as hard. But that might be like a minimal help there. So that's something to kind of keep in mind, right? So the bottom line is the Fed does have to keep cutting here. They probably don't have to go insane with the cuts right now. They can probably stick to 25s and 25s for a while. But the moral of the story is they do have to keep on the cutting cycle. Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with.
Investment Management Chief Market Strategist, Drew Mattis. So only one more. Market still is at 2 more.
People think maybe the Fed got a little ahead of themselves.
Wait, you think the reason gold is rising is because people don't think the Fed can control inflation?
I think they think that 50 was a mistake and that it put in market expectations for a significant amount of more easing that are unlikely to be fulfilled.
Ooh.
Right, but ultimately, doesn't it just matter if inflation flares back up? That would be the mistake. Do you see that happening?
That would be the mistake, but if you look at 5-year inflation break-even, so inflation from years 6 through 10, what we're actually have seen in the last month is that's up about 10 basis points. So about a quarter of the move you've seen in Treasury yields can be attributed to long-term inflation expectations rising.
Because the Fed's effort to fight inflation fails.
I think because the Fed has given up in fighting inflation, they switched to a growth story. That was the September 50 basis point ease. And now people are still expecting them to continue to be very aggressive, yet the other markets are telling you that maybe it's not the best idea to be aggressive right now.
Kind of fits with what Paul Tudor Jones said yesterday, and that is try to keep inflation on the high end of the range, grow and inflate your way out of what is a difficult debt and debt.
So only expecting one more rate cut this year. Yep, I agree with that. 25 basis point, one more cut, and then they're going to be done. Forecasting increased economic and market volatility. That could be. Thinks real assets will continue to outperform. Interesting.
Situation, yeah.
Certainly, and I think if you're the Fed, that's probably not the worst idea. Particularly, we have a very positive view on productivity over the next 5 to 10 years. Everything, all the investments that were made during COVID, all the investments that have been made since.
By the way, even though I think they're going to cut 25 this next one, I actually do believe they should cut. Like if I was choosing, I'd cut 50 again. Then I want to see how holiday sales are looking, and then potentially, go with either 25 or 50. Come, Q1 of 2025. So you got to skate to where the puck is going. And the moral of the story is we got too much weakness out there to be at this sort of Fed funds rate with the CPI that's on its way to being under 2% here soon.
Technology progress we've seen across a different number of categories, biotech, space, etc. They're all going to start interacting. And when that happens, I think it's going to look a lot like the 1990s from a growth perspective, where you have very high trend growth in the United States, high nominal growth with kind of more moderate inflation perhaps. And you should be able to grow your way out of some of the deficit story if you contain the deficit at levels that are kind of a little below where they are now. So, in order to get that deficit down, you don't have to kill yourself, but you do have to make sure you stop digging the hole that you're putting yourself in.
Can I just ask, speaking of 50, Canada goes 50 today, 4 straight. Is there oddness in the asymmetry between what's happening a few miles away? I mean, I think the U.S. has had a little more forward momentum than they've had, so we maybe need a little less help. There are signs of concern in the U.S. markets, though. I mean, for me, housing and kind of the dysfunction within the housing market is a significant one. Yeah. Rates came down kind of up until recently, and yet we saw home prices actually begin to decelerate, home price appreciation deceleration, not really what should be happening when rates are moving lower in the housing market.
Right. I mean, housing's funky because there's a supply shortage, right? And now buyers are coming back online, so I guess...
There's not a supply shortage. Oh, that's such a freaking BS thing. They keep talking about there's housing shortage, There's not a housing shortage. I'm here to tell everybody there's no fucking housing shortage, okay? Everybody's going to see real soon there's no housing shortage. There's no dang housing shortage. The amount of homes, apartments, everything that's been built over the past 10 years is astronomically high. It's ridiculous, specifically on like multifamily. I'm talking like apartment complexes and things like that. The amount of those that's been built over this last 10 years in every major city is like numbers you've never seen before. It's ridiculous. There's no housing shortage. There was, because the economy got so hot, it led people to believe there's a housing shortage, because when the economy is very hot, everybody's feeling great. They go buy extra homes. They go buy real estate investment properties, right? People move out of their parents' home and this and that, and it's just like boom, boom, boom. And then all of a sudden the economy gets, like, people were convinced there was a house. Before the great financial crisis hit, people also thought there was a housing shortage. There was a housing shortage prior to the great financial crisis. And then what did we find just a few years later? There's a housing surplus. We don't know what to do with all the homes. My city I live in nowadays, Vegas, they didn't know what to do with all the homes. There were so many foreclosed homes. They're like they had all these like plans they had to implement and whatnot because there's too many damn homes everywhere. Everybody's like, there's too many homes. The home builders like almost stopped building. It was like their numbers went down so significantly, it's ridiculous. The home builder stocks fell 70, 80% plus. Right? In the city I was living in back in those days when I was like 18 years old, there was Phoenix, right? We had too many damn homes. They were everywhere. There were short sales everywhere, foreclosures everywhere. Apartment complexes were desperate. Even apartment complexes were still desperate when I moved out of my parents' home in 2011. In 2011, I got a $750 payment on that apartment complex. Full in, right? And I think that included water and trash as well. And that was a beautiful one-bedroom apartment in a great area, beautiful countertops, the whole thing super modern, had laundry right inside my own apartment. Like, it was gorgeous. Beautiful pool, gym, all that stuff, right? $750 a month. And if I recall, they paid my first month and my last month, right? Which was a whole, but why were they doing that? Because there was no housing shortage. There was too many damn places to live. And that's what people start to realize if all of a sudden the economy gets shaken. If all of a sudden you start to up unemployment, what happens? People start moving in with each other. Family members start moving in with each other. Friends start becoming roommates. And all of a sudden you realize, whoa, we didn't need all those homes. The real estate investors go belly up that are too highly leveraged. The guy that owns 8 properties got way over leverage, all of a sudden has to sell all his properties, has to liquidate them all because he can't find tenants at attractive pricing. He paid me way too much for the properties. And all of a sudden you realize, there was no housing shortage. There was actually too much damn housing. That's what you find out over time. And that's, we'll see. But I can tell you, if the economy goes a negative way, people will be talking about, it's going to be so funny looking back at this. Oh, God.
Pressure on prices.
And people don't want to cut their prices because it's like, my neighbor got this. Why would I possibly cut my price? Mm-hmm. And so it's just kind of stalled. But when that stall gets restarted,
when the desperation comes, that's when people start lowering price like crazy. Like, I've got to move this house and drop it to whatever price we can freaking sell this thing. When that happens, boom, the game changes immediately. And the more people you have like that, those are people that actually reset the housing market. So unfortunately, it comes from the desperation. The people the over-leveraged real estate investor that can't find tenants all of a sudden, and he's like, crap, man, just move this damn property. I need to get rid of it. All of a sudden, people start foreclosing, short sales, all that crap. Then all of a sudden, that's what drops the market down. And everybody starts getting really real, really fast around their pricing. And the person that's not that desperate, that needs to move, also starts to realize, crap, I can either price this at some ridiculous price or I can price it as something that will move, right? And then all of a sudden you start actually having movement in the housing market again.
There's a potential for home prices to actually behave in a way that we shouldn't expect, which would be a decline in home prices. Mm-hmm. And that's going to get all those homeowners feeling a little more or a little less positive on the economy.
So if I'm taking your sort of worldview into account and what it means for the markets, I feel like it's what we've seen. It's equity friendly, not so much for bonds, though.
It's equity friendly. I think, to the extent that inflation is going to be higher for a sustained period of time, it helps to explain credit spreads, because inflation is a credit positive event because these companies borrow in nominal terms. And that means, maybe it helps to explain even things like high yield spreads.
I can't get over the whole housing shortage thing they keep talking about. Cracks me up.
Mortgage rates that we've seen lately is the equivalent of a 6% increase in a home's price from a monthly payment perspective. Let's bring in Alan Ratner with Zelman and Associates. It's a Walker and Dunlop company. Alan, welcome. So, this has an impact.
So funny.
Yeah. Hey, Kelly, thanks for having me. No question it has an impact. There's a lot of noise in the housing market right now. Diana mentioned the election, higher rates, et cetera. But at the end of the day, this is a market where affordability remains incredibly stretched. There was a lot of optimism this time a month ago that rates would be continuing on a downward trajectory, maybe even dip into the fives. And of course, we've seen a reversal there. So it's important to keep in mind what impact that does have on the consumer. And every 25 basis point increase in mortgage rates is the equivalent of a 3% increase in home prices from a monthly payment standpoint. So this is really pinching the consumer's wallet.
Yeah. What does it mean for the housing market overall?
Well, I think from the housing market perspective, we continue to see a slow grind higher over the next several years. Rates obviously off of the bottom here, but still down year over year. We're still seeing a solid economy. And I think from a very high level, more inventory, as long as it's not distressed, is a good thing to kind of get the wheels back moving again in the housing market, because the resale market has really been constrained by a lack of inventory. The new home market, on the other hand, we're continuing to see solid activity there. The builders have a real competitive advantage. They're able to buy down mortgage rates so they can solve at least a portion of that affordability issue for the buyer. And they've taken a good amount of share from the tight resale market.
And in that case, where does that leave the home builders?
Well, I think right now, from a home building perspective, we continue to see mid-single digit volume growth, where the stocks have been under some pressure recently, down about 10% from the highs. I think is more around concerns about gross margin and what impact those mortgage rate buy downs are going to have on margin. So there's demand for homes and they're selling homes. The question is at what price and margin. And right now, just given where affordability is, we just don't see a lot of opportunity to raise prices or lower incentives to drive that margin back up.
I can't wait for these home builders to get hit. I can't freaking wait. Some of you guys, you probably haven't dealt with home builders because you probably haven't built the house in like the last few years and whatnot. But I can tell you they're so freaking cocky. It's ridiculous. The moves they're making is so greedy. And respect is business, man. It's business. Be greedy. Like, do your thing. But I can't wait. I can't wait for the day of reckoning on those freaking home builders, man. The games they've been playing over the last several years, it's ridiculous. Making people bid against each other just to get a lot. Like, oh my God, like there's just so many games they've been playing with consumers because they've been in such an insane, position of power. They were in a huge position of power for many years, right? But that's going to go away, and it's going to go away very soon here, and so it's going to be interesting to see that. But man, all their businesses have been pretty much at all-time highs, revenues, profitability, margins, all those sorts of things. And they've been able to just have their way with the home buyers because they've been in just such a position of power. But, these things don't last forever. They cycle around, and the next thing you know, all of a sudden they're going to be desperate, wishing they had customers. It's going to be interesting.
although that's what we're hearing from some of the builders that they're doing.
Yeah, so I think a month or two ago, there was a lot of optimism in the industry that this time, I'm sitting here mid-October post the Fed rate cut, that they would be able to dial back those incentives. They would be able to stabilize margin.
They're about to go,
and that really hasn't happened. We've heard from a number of companies over the last several weeks, and now earnings season's kicking into high gear, that incentives remain very competitive. Rate buy downs remain very prevalent in them.
And it hasn't even started. It hasn't even started to get really incentive heavy. Just wait.
And that's putting a bit of a downward pressure on gross margin.
All right. Alan, thanks so much for joining us. So we appreciate checking in with you today.
Before you know it, they're going to be discounting land. They're going to be discounting the homes. They're going to be giving crazy amounts of potential options in the homes. Oh, you just wait. Especially once all of a sudden the existing home market, the inventory starts to pile up even further than it's already piling up. And then you start getting some folks that are desperate and they start moving prices down in a lot of markets. Oh, man. Wait to see how, like I still wouldn't even consider buying a new home from a home builder right now. Oh, no. A year from now, it might be a very, very, very different story in regards to that. So that shall be interesting, okay? All right, guys, appreciate you joining me as always. Fun times. It's an interesting market. We got drama.